Type 9. Type 9.
Going on, everybody? Welcome into another pre-market live stream here with the Everyday Growth Advisors. I hope you are having a good morning. Once again, Powell shitting the bed in classic fashion. We will go through the macros and then look at the technicals right after that. Definitely a lot to unpack here, so let's get straight to it. Thank you very much for attending the live stream. Hope you guys are having a good morning. And also it is Friday, OPEX day, the quarterly OPEX for the year, and also the last one for the year, looking at $4 trillion roughly of expiries today, which is a big amount of money. This is the second biggest OPEX ever, which means expect a lot of volatility. Okay, so let's break it down. Macro, some stuff definitely changed. Powell came into the picture. I was warning you guys about this ever since Wednesday when CPI data came out. I was like, hey, listen, you know, we were pretty much somewhere up here. I was like, hey, you know, be careful. Powell's might say some out of pocket kind of stuff, and you know, it might cause the market to get jitters. In true fashion, he came on. He became the clueless whisperer of the season. And gave us the most confusing FOMC breakdown we've seen this year. The market obviously did not like that, and what initially caused this little sell-off here was the main rhetoric from the Fed that was concentrating on rates and the dot plot being pushed upwards and forwards into 2023. That's right. That means instead of us expecting the dot plot to shift into a positive fashion somewhere in the second half of 2023, Powell reiterated, or rather he reinforced, that the Fed is going to hold interest rates higher for longer. And in response, they put out this dot plot graph, and I'm not sure if some of you know how to read this, but I'm going to go through it with you guys so that you can understand, because you got to be able to understand what's going on. So this is what we call the dot plot from the Fed, and let me see if I can make this bigger actually. Hold on one second. Okay, that's the maximum size. So this is what we call a dot plot, okay, and it represents all the votes by all the Fed governors in terms of what are the expectations for interest rate changes in the prevailing year or in the years to come. Now you can see that the dot plot obviously for 2022 we're now over with it, so it all sends the rate expectations at where we are right now, between 4 to 5%, almost at 4.5%, and this changed for the 2023 dot plot. In fact, it was specifically these two upper dots that you can see here that have changed. The expectation wasn't for us to go closer to 6%, but rather stay pegged at between 5 to 5.5%. And it pretty much sent us having these two outliers on either side, which is causing a lot of the ruckus in the markets right now. What we are seeing is that the Fed has now unanimously decided, or as a group decided, that they want to keep rates above 5% and up to 5.5% or more than 5.5% for the whole of 2023. And then obviously, as you can imagine, that going forward, since you don't have the data for 2023 yet, it's very, very sparse, and the dots are obviously plotted all over the place, because the expectations for most of the Feds would be to be at around 4%. That means expecting a fall in rates or a rate cut. And then finally in 2025, you can see further, resumption of the rate cuts, and then the rates finally moving down into that 2% range once inflation gets under control. So this is what has changed, and that's what the market really didn't like. Now, a couple of things about this. We are, of course, off the view, and I have said this many times, that the first half of 2023 is going to be a very painful one. Mainly because we have earnings contractions that are on the way. We have supply side pressures. The COVID policy from China still has not been sorted out, even though they have opened up and then committed towards liquidity. They've also, put out measures to improve the situation statewide. But we're not seeing that immediately happen. So it's something that's still on the books. And if only the things in China start to clear up, that's when you will see a lot of these supply chokes start to become better in terms of those price mechanisms. So that's one pressure that's acting on the market. The other pressure that's acting on the market are the geopolitical concerns, and then also the interest rates remaining higher for longer, which are going to cause headwind, problems for corporate America. It's going to cause significant pressure to margins. Right, margins will become slimmer. Not to mention they've laid off a whole bunch of people, so productivity is probably going to go lower. Obviously, it doesn't necessarily mean hand in hand that employment is going to directly impact margin, but that we would be of the view that there will be some earnings contraction that will lead to some kind of a recession heading into 2023. So that's what we are thinking heading into the next year. Now, that caused a sell-off in the market, and actually, honestly, the sell-off in the market wasn't just the dot plot, but it was also the fact that people couldn't quite figure out what Powell wanted or what the Fed is actually saying. You realize after the speech, we just hung out around here at the key pivot point 3950, and then the sell-off happened. It was pre-market, before the market opened, where we started to flirt with the box. Right, I told you guys about the box before. And then when we broke below the box, we didn't really see much of a continuation. We broke below the box barely and then started to bounce. And again, once again, pre-market, they sold off today. heading into this new range here, which is now setting up to be a pivot point once again. So the forward-looking price action that we are expecting here is obviously further downward. As I mentioned, once we break the box, then all hell breaks loose for us to test 3806, and that's going to be a run towards that level. But remember, it's never that you're going to see something get to there immediately within 1 to 2 days. It might take a little bit of days to get to that point. After all, as I've mentioned before, the snake needs to digest the gazelle that it has just ate. In other words, the market needs to move sideways for a little bit and consolidate this price action before it can move to another zone to find liquidity. We haven't quite found that liquidity just yet. Remember, it's very easy to judge when we hit a liquidity zone, because that's exactly where prices will start to buy up very quickly, and we'll see a reversal in the short term. Okay, so long term here, heading into 2023 H1, we are definitely going to see some pain for the S&P 500 further. Whether we're going to go down into this lower lows here, I can't be sure of this, and there's no way actually to tell. My view is that we won't get lower than this, but then again, I have been surprised before. If earnings really come out dismal, then yes, we will get lower than this. If earnings don't come out as dismal and we actually get some surprises of better performances from companies after having the cuts of employment, yada yada, then that might actually be a positive surprise for the stock market, and we might bounce somewhere in the middle here. So don't take everything for the gospel truth, nothing but the truth, and everything but the truth. Be optimistic, but don't be too optimistic. Be pessimistic, but don't be too pessimistic. In other words, don't get overly emotional, because that's the easiest way that you will hoodwink yourself into making bad decisions. Now, as I have mentioned before, we're never going to come down in a straight line into our targets. So we are definitely expecting some moves to the upside before resumptions to the downside. And we have seen some bullish options flow coming in over the past 1 to 2 days for market makers to take some upside exposure, but maybe that might not be heading into OPEX or just immediately. But we are definitely seeing more pressure to the downside than the upside right now. Very little buying on the uptick on the flow for the upside so far. And we'll be waiting for more confirmation to see when we can take more upside to play this back test of the 3900 or 3950. Either one of these have to be back tested. So we'll definitely see one of these in the near term, probably within the next 1 to 2 weeks, before the next resumption of fall in a classic wave fashion. Okay. Now, looking at the NASDAQ, it's in a very interesting spot here, because once it loses this level here, the next level for it to retest is going to be down here at the 10,000. So it really has to hold this 23.6 Fibonacci retracement level. If it doesn't find a bounce here, then we could definitely see tech bleed. Now, the past 1 to 2 days have seen an immense amount of outflow from tech specifically. Okay. And then on top of that, you have all kinds of added pressures with winter around the corner, but summer now over. There's lower demand for oil and gas. Not specifically, just talking about the fact that people will use a lot of energy during winter, but there is lower demand of energy during winter months than in summer when everybody's out and about. We are also seeing OPEC talking about cutting supply, which in turn is going to affect a lot of these prices for oil and gas, which the market in oil and gas is already pricing in with this downward move here. There are specifically 3 sectors that you need to be aware of that will be bearish in the next sector rotation, which will be technology, energy, and financials. These 3 will heavily be affected by increasing interest rates or inflation being higher than usual. And then 3 sectors that will benefit from this, which will be healthcare, consumer staples, and utilities. Okay, these 3 are defensive sectors. It doesn't matter what happens to the economy; these 3 will be bought. Their products and services will be consumed irregardless. No matter what you do, you get sick, you need to see a doctor. That's the reason why healthcare becomes a defensive sector. No matter what, you still got to buy shampoo and whatever else not. That's the reason why consumer staples will remain a defensive sector. No matter what you need lights on in your house, that's the reason why utilities will become a defensive sector. So a lot of this that you're seeing coming out of these three sectors will likely rotate into these three sectors. And that's just the usual playbook. I'm just laying it out for you guys so you have a better understanding of how things go and rotate in the stock market. You should also possibly put this on a cheat sheet because it always comes in handy. Now, a lot of the pain this morning came from IWM dropping pretty significantly. Also SPY dropping here with energy being bulk of the move. Energy down, about 2.3%. Technology down about 1%, let's just say, and financials down 1.27% here. So these three, the main bleeding sectors, right? As I mentioned, healthcare also down about 1%, and consumer staples also down about 1%. So it's majority of the market is kind of bleeding here, but there are pockets that are bleeding more than others. Energy being one of them. But remember, don't let sector rotations rule your life. One thing that you need to understand is all of these have a specific allocation within the S&P 500. If you don't know what that allocation is, go to FinViz and you'll get a visual representation of what that is. Remember that technology is the biggest allocation in the S&P 500. Then comes financials, then comes communications, then comes healthcare, then comes consumer cyclicals, industrials, consumer defensive, then comes energy, then real estate, utilities, and basic materials, which are all the smaller sectors. So when people say, oh, it's energy causing the S&P 500 going down, it could be a combination of things. It can't be just energy, okay? Remember that. So whenever you hear that from your favorite gurus, remember to also take that into account. The weight of the sector makes a big difference. If technology moved down in unison, it would make a much bigger impact than if energy moved down in unison. That's what I'm trying to say, okay? Because the holdings in the S&P 500 will be moving in that magnitude. Okay, so small caps obviously getting decimated here. We spoke about the fact that they've been breaking down. I never got a pullback to enter this, so I never entered the IWM position. But at the same time, we have been initiating positions in a short position for gold to play a broader secular trend. Remember that higher interest rates for longer means that QT will be done for a longer period of time. And if QT is done for a longer period of time, that results to the dollar going up in value. And if the dollar goes up in value, then gold comes down in value because they're pegged to one another. So that obviously we're not looking at a short-term move here in gold. We're looking at a longer-term move. In the short term, prices may remain erratic, and you might see gold do some of this. But eventually, as more QT is announced, or even the bond selling program is announced, then we will see gold fall back down. So as a secular trend in the trade, you could take gold out for a longer term trade scenario for the future. That's just some basic macroeconomics for you guys, and a simple way to make sense of things and trade around it. The VIX being at 23.53, flirting around with that first danger level. We haven't really seen the VIX do much in the past couple of days, except for just go up and down. But after this OPEX expiry, we'll see a lot more unwinding of positions and then re-hedging of positions, which should cause the VIX to kind of go back to its volatility. On top of that, bonds just trading a little bit lower this morning, about 1.62% down, and the dollar index spiking just a little bit here, but still has not broken out to send us down in an aggressive manner. Remember, dollar index also correlated to risk assets, equities, and also commodities. So those are just a few things that you got to keep at the back of your head. Okay. Some tickers that have been trading in a very unique fashion. Tesla snagged the 38.2 retracement and then wasn't really able to go back down to the 61.8. We'll see if it goes back up to the 23.6 and retests it. If it fails to break out of the 23.6, then we might see that resumption back down to 61.8. If it gets above 162 roughly, and starts to bounce on this level, then we might see upside on Tesla back into squeeze into this channel. Apple broken down from that pennant. We played this one beautifully this week. Right when it broke down, we started to initiate a short position. We took some 138 puts. I'll break down all of the trades that we took this week. So far this week, it has been quite a magical week. I've managed to pull off this week with absolutely no losses so far. As you guys know, I share this sheet with you guys every single live stream, and you can see the development of the trades, what we take, etc. And yeah, this week has been a pretty good week. I don't want to jinx it, but so far so good. Now, I also understand that from the previous live stream and some of the comments that I've been receiving, as well as DMs, that you guys want to see the breakdown or what all these trades were, how they were taken, and you want to know the psychology behind it. What was the entry? What was the exit? Where did I enter? Where did I exit? How exactly this was done. So what I'll try to do this weekend is do a summary, maybe a 9-10 minute video where you can watch and learn a post-mortem breakdown of all of these trades. Does that sound good to you guys? Do you want that? Tell me right now in the comments if you want to see something like that. Also tell me what you possibly want me to break down in that 9-10 minute video, and if it will be of interest to you. Okay, cool. So I will take some time out to do that for you guys and this weekend, and hopefully I'll be able to do one video like that every week so that you guys can get a good understanding of what the week looks like. This week I didn't manage to break my target once again, but closing out $58,000 in the week is not a bad week at all. So I'll take it. It was a great positive week. Yeah. Okay, so other things. Drop your tickers that you want me to break down right now in the comments, because we have about 5 minutes more to go, and then I'm going to get off the stream. A couple of things that I'm watching just to bring your attention to it. Costco. Now, this is a consumer staple stock. It also falls under retail, but it has broken down below this pennant. Now, I don't want to tell you guys that this is an immediate bearish opportunity, but remember what I always say: once you break from a pennant, don't immediately trade the bearish outcome. You want to see how this reacts at this pivot right here, and actually what you want to wait for is the bounce to the upside. Once you get the bounce to the upside and you see that it starts to reject this 480, what is this, 481 or 482 level, which is the retest of the pennant, or even if you come up to around this level here, which is 475, and we retest that level, and so it's either here or here, right? You can see those are the two clear levels. So here or here, right? Then once we see the rejection, we can take the bearish trades. Other than that, I wouldn't recommend shorting this sector specifically, because it falls under a sector that will do well in times of uncertainty. Okay. The other one is Netflix, that just broke, and I've been telling you guys about Netflix for a while now, right? We traded Netflix this week as well. It was in fact one of the first few trades of the week. I remember that. Yeah, it was the first trade of the week. We traded Netflix short when it was rejecting the top trend line, and I'm looking to short it again if we can get a retest. Okay, so in other words, am I interested in taking bearish positions today? Probably not. Okay, probably. The keyword being probably, mainly because I want to wait for some pullbacks and see how this market does in terms of once we pull back, and how we're going to react at some of these upper levels here. And I'll be more happy to take short positions after that, rather than going long here or going further short where premiums are already very, very much so busted. Okay. So that's kind of the thesis that I want you guys to operate or think through today when you're trading. Don't be too trigger happy to take downside positions now that it's so overextended to the downside. You should be thinking like a market maker as to how would you trap retail traders into taking more exposure to the downside, and then you yourself take that position to the upside. In other words, wait for the oversaturation of puts before you squeeze, right? And I already mentioned that there is a possibility of a squeeze. It's just waiting to happen. We just have to wait for it to happen. And therefore, on an OPEX day, the last thing you want to do is over-assign risk to the downside here when we've already made such a huge move to the downside. Okay. So all in all, my advice to you for today is try to be careful in terms of allocating risk. The move for the downside has already happened. We're at some key pivot points. The best move here is to wait. It's to wait and sit on your hands till you can get an opportunity that is once again in your benefit. Right now, this is not in your benefit until and unless you take a long trade. And it doesn't mean that you can't keep going further down. As you know, today is OPEX. So a lot of these gamma trades might be unclenched. Okay. And yeah, that's all I pretty much have for you guys. I want to say thank you guys to all of you for attending the live stream. Once again, make sure you smash the like button. I appreciate you guys taking the time out to be here. And yeah, we'll have another live stream for you guys on Monday. Back again. Make sure you guys have a great weekend. Take a well-deserved break off. It's been a messy week in the markets this week. And get your mentality and psychology in order before you get in the market next week, because it's going to be a rough ride. There is one thing I will say, which is if you thought that 2022 was hard, I think 2023 is going to be worse for equities. And at least the first half of 2023 is going to be really, really terrible for equities in terms of performance. But once again, until and unless we see data that changes our, the outcome or the possibility of that, I think that we should view this through, a lens in which we are measuring everything agnostically and just being very, very optimistic about the future instead of being pessimistic. So for now, even though it might sound like I'm trying to tell you guys that we're going to go to zero, that's not what I mean. I just mean be careful and don't take unnecessary risk. All right, guys. Well, I don't see any questions, and I'm going to jump on the live trading session with our members on Discord right now. So I hope that you guys have a great trading day, and I'll see you guys back on Monday. Take care and peace out, and I hope that you have a great one. Bye-bye.